So all this fuss about discretionary trading and quant trading, what are they? That's what we're going to get into in here in episode 5 of the Independent Quant podcast. I'm your host, Luis, the founder of the Independent Quant, and let's dive right in. What is discretionary trading, and how's that any different than quantitative trading, which is what the Independent Quant's all about? Well, let's get started with discretionary trading. So what is discretionary trading? So discretionary trading is a very manual way to approach the markets. It's very emotional in nature. There's no necessarily a systematic way to approach the markets. You are using news, using whatever information is coming your way to place and manage your trades. There are some really successful discretionary traders out there, but it's just very difficult to achieve, especially within a short time frame. And by short time frame, I mean, you take on trading because you want to make money in the markets. Well, now you're choosing a strategy where you have to get a lot of self-control, get a lot of just second nature skills that aren't easy to develop. If you were hoping to be trading the markets within, 8 months, I don't know, discretionary trading, not really for you. When I was having success with mine, it took about 8 months really of daily trading to get to the point where I was getting really good, but I was still a fairly young trader. I made a lot of mistakes going along the way, which is what you find with a lot of discretionary traders, is that emotion jumps in when it shouldn't. And also the nature of it that you don't have just those hard and fast rules as to when to go in and when to go out. It's very difficult to know if your strategy is really going to work or if your strategy even does work, because you can't go back in time, try to find all those cases where you could have entered and where you would have exited. Technically you could, but you actually can't, because there is so much emotional and just non-information based decision making going on that you can't replicate what you would have done had you been trading the markets 10 days ago. So you can't back test whether or not you have a successful strategy or not. Now, that said, one of the big advantages of discretionary trading is that it does provide you flexibility. A discretionary trader can do that one thing that a computer absolutely cannot do, and that is adjust to the markets. It can't flex to the current state of the market. It can only follow the systems that have been coded into place, and that's it. Another advantage of discretionary trading is that you get awareness of just the context of the market. As traders, even as quantitative, systematic, and algorithmic traders, we still need to be very familiar as to what is happening in the market at large. Microeconomic forces play a key role to any trader, regardless of their discretionary or quantitative. But a discretionary trader has the huge advantage of really being able to assess that, because it's required for them to go through each one of their symbols, maybe look at what the Fed has put out and all of that, do a lot of contextual information as to what is going on in the market, what's happening in the economy, how could that factor into the trades that they're making. I'm a swing trader still, and for that style of trading, it's not discretionary. I'm using a system and I am following it to a T. I know exactly where my entries and exits are, which is ultimately the system that I'm looking to codify into a quantitative algorithmic strategy. But within that strategy, I am looking at what the macroeconomic factors are, where the market has been. So there is an element of that doesn't have to purely remain within the discretionary trader's toolbox. That's something that we can inherit as systematic traders. But all the same, that's very much a strong suit of discretionary traders. They have a good understanding of what's happening in the market. And lastly, it's creativity, intuition. Because they can flex and understand what's happening in the market, if they have that emotional control, they can adjust and find ways, given what the market conditions are at that moment, to adjust their entries and exit accordingly. In contrast to that, what is quantitative trading then? Now, I've kind of hinted a lot with what quantitative trading is by contrasting discretionary trading as I was describing discretionary trading. But quantitative trading is very much just a rule-based systematic approach to the markets. You have a method to identify exactly what your strategy is, and you can clearly define when your entry points are into a market, when it's your time to get out of the market, when to trade and when not to trade. that is a strong, strong position to be in because you're using statistics and historical data to inform your trading, which allows you to get consistent far more quickly than you could using the discretionary method. You're not tied to a single strategy. When in discretionary trading, you have to master a strategy before you take on another. With systematic trading, it's possible for you to try multiple strategies at once, track their performance because your emotions aren't part of it, your human instincts aren't part of it. So you can go back in time and see where those conditions for the markets were and see if that strategy would work. So you could have developed multiple strategies at the same time, go testing them out, see which one works because of how robust and particular we are about what constitutes an entry, how to manage a trade, when to get out of a trade, be that losing or winning. We can have a computer do that for us, which is coding an algorithm. Backtest is something that, I kind of hinted at before, but to kind of drive it home is because you're using statistics and historical data, you can, using the software that your broker provides, or if you're using your own programming language, depending on the programming language you're using, for example, Python, you can use those resources to test out how that strategy or strategies would have performed in the recent market, right? What is the risk profile of that strategy and how much money would you need to be able to trade that strategy? And how does that strategy then compare to maybe another strategy? Are they complementary? Are they supplementary? So you're able to glean all this information by the ability of backtesting a strategy, seeing how effective it would be, and then seeing if it has a place in your portfolio. Once you've assessed that a strategy is profitable and within your risk parameters, you can take that and you can run that in simulation. That's validating the strategy using a sim. So when we look at back in time and you back test a strategy, sometimes the logic that's used to fill orders or to test a strategy are different than if the data was live and streaming into the platform. So you validate by putting a sim in the market and seeing how it actually performs. So you get to see if it performs comparably to its back test and whether or not it's actually a good strategy to be using in the market that you're in right then and there. And then once you've validated that, yes, this is a strategy that you're comfortable with, it does satisfy your risk management criteria, you can take that strategy live and you should see the same level of performance. But likewise, you can also track that performance and make sure that it is providing the benefits that you anticipate out of it. So the advantages of quantitative trading, and again, here at the Independent Quant, I use quantitative trading in a much more liberal fashion that's used in the industry. Quantitative strategies are typically those statistical strategies. I don't limit our group to exclusively statistical strategies. I am migrating to more statistical strategies, but I am very much still a technical analysis trader. So a lot of the algos that I code are within the technical analysis realm. So here we're very open to what constitutes a quant. If you are using statistical strategies, but more importantly, if you are using a systematic way of trading and hopefully even an algorithmic way of trading, which is what I promote because that's what I'm building as algorithmic trade desk, then you're a quantitative trader for sake of our conversation here at the Independent Quant. What all those three methods, quantitative, systematic, or algorithmic, what they give us all is that emotion-free trading. Really explain that because it's not really emotion-free, but comparatively speaking to a discretionary trading, which is the only other alternative, is it's emotion-free. And because you're not there in front of the computer assessing whether or not conditions have or have not been met to make a trade. There's no, I need to jump on this trade right now because of FOMO, fear of missing out. I'm missing out on this trade. I got to jump on and take this trade. You eliminate all those drawbacks. Now, why it's not emotion-free is because you're supervising an algorithm. The algorithm, you've tested it, you've back-tested it, you forwarded tested it, you validated it. So you should be confident that it can perform per all those parameters and all those things that you saw it perform. But once it's live and actually trading real money, sometimes it even happens in sim, but when it's trading for real, it's difficult. It's difficult to not want to intervene. And that's something that we do have to condition ourselves to. But I'd say that is a much easier problem to solve than trying to get emotional control of yourself at all times as you're actually trading. All you have to do to satisfy, this emotion, to get to emotion free, is just don't have your platform open looking at it while the algorithm's trading. Just leave it alone. Look at it when it's done for the day or the market isn't moving, and you can sit down and assess and just look at the numbers, see how the performance is, and make a decision then as to whether or not to turn off the algorithm. But yeah, that's one of the huge advantages of just quantitative trading. And because of that, because we remove that emotional aspect of it, and because we're able to back test it, forward test it, validate it, it really grants us the opportunity to be more consistent and have more repeatable success, because you can generate more strategies and strategies, that's one drawback to this, which we'll get to, but is the strategies don't last forever. So as far as being successful and profitable, but that's okay within the quantitative realm, because sometimes all that means is you either got to tweak the one you're currently running or tweak another one that wasn't working, but now you can get it to work. But you can repeat your success much more quickly than you could if you were using a discretionary method. For scalability, one of the challenges that a discretionary trader has is as they grow their account, they start to be able to take more risk or take a larger position size. That can create mental havoc for you. I mean, it's because the numbers become bigger. The losses become bigger, even though if you're using a percentage-based risk method for your trading, it still constitutes a much larger number of your account as a dollar value. So it makes scalability a little more challenging. Quantitative trading kind of addresses that, because the system and the algorithm, if you're trading algorithmically, is going to take care of that for you. Now, I kind of hinted at a couple of the challenges of quantitative trading. The first and really big one is the technical expertise required to be a quantitative trader. Like I said, I'm very broad as how I define quantitative trading. However, if we look at the statistical aspects of it, I'm a data scientist. I've done machine learning engineering and those types of roles, but that is I have not done that in the market at the time of this recording. So I've been a technical analysis trader for very much now, almost 10 years. Coding those strategies are much more simpler than coding a true quantitative strategy, which is using statistical methods. So that's the first part of it. The second part of it, let's say you don't come my path and go, okay, you know what, I don't need to do purely quantitative strategies. I can start with a technical analysis or a price action base, something that makes sense and you can visually inspect and assess whether or not the conditions for entry and exit have happened. You can go that route, but there still remains the challenge of knowing how to program. You need to be able to know how to tell a computer how to execute that strategy and code the strategy and verify that, if there's any issues that you see in performance, that it's not because of your technical ability and not just the strategy actually being wrong, but you need to be able to have that comfort. This can be mitigated, though, because generative AI has been a phenomenal resource to this. Tell generative AI what it is that you want, and it will give you the code. Now, I get into this in my mini course. If you haven't gotten that, go on to the Independent Quant and take a look at it. I cover this in a little more detail than what I'll be able to here. A generative AI will code a strategy for you, but you still need to understand what it coded. The beauty of it is you can ask it, hey, take me line by line and explain what you did. The problem is that generative AI, as of right now, spring of 2025, still causes a lot of problems. It still generates a lot of trash as far as, hallucinations, as they're called. And that's not really ideal when you're trying to code a strategy. So you still need to understand how to read code. Even if you don't know how to generate the code, you still need to be able to inspect it. So that makes the technical expertise required a barrier to entry into quantitative trading. But I still argue that this is the best time ever to start addressing that, because there are resources available to get that learning curve not as steep as it's been in the past. Another thing that is a challenge for quantitative trading is data dependence. If you are using, a model that isn't just using market data, but is now has to, like, the fanciest of fancies are using satellite imagery and alternative data sources, as they're called. Well, that now means you need to have access to that data. And some of that data is not cheap. It's very, very expensive. It may be a barrier to entry for many of us, but the need for data in order to execute those strategies could be a huge detriment to the number of strategies that you could build. Next thing, and I'd say the last thing, is market regime changes. Like I said, a strategy won't work forever because the market continuously changes. It changes week to week, day to day, month to month, year to year. We're not always in the same market. And because quantitative strategies and algorithmic strategies are so particular in how they enter and exit trades and how it assesses signals for entry, it pretty much limits it to being able to work within a certain market regime. And what's a market regime change? That could be anything as simple as just, we've gone from summer to fall, there's spending changes depending on the symbol that you're using. If you're using something that, trading a company whose stock goes up, like a retail store whose stock rallies at the end of the year because that's when sales happen, their revenues are going through the roof, and then falls off come, post holidays. That, at its most simplest, is a regime change where you're going from potentially a market that's doing nothing and going sideways to maybe rallying. So now you're in a trending market. So that now your strategy, if it depended on a sideways market because you're using a mean reversion strategy, and now you have a trending market, it may not work. It depends on how that strategy works, but typically that's enough to make it stop working. Now that's on the simple side. On the more complicated side is whenever Congress or the SEC implements a new rule or a new law that impacts the markets, it may change how people interact in the markets, how orders are handled in the market, just the market structure. And that now may change whether or not you have a good strategy on your hands. So, and that's something that you need to keep in mind as you're going through and choosing, assessing whether to keep a strategy on the market, is assessing what the market dynamics are, which I said, like for the discretionary trader, it's something that's not unique to them. We as quantitative traders do need to understand what the microeconomic forces are that are driving the market. So that was a lot to kind of digest there. So how do you choose which one's right for you? I think these are my words, obviously, is my opinion, but if you enjoy actively looking at the market and the challenge of just overcoming yourself and getting yourself to the point where you can completely trust yourself to take specific trades at specific conditions and you can adjust to whatever the market's throwing at you, if that's where your vibe is, then maybe discretionary trading is for you. There's nothing wrong with discretionary trading. We just have to understand what the drawbacks are and what the requirements are to be successful. And if you're willing to pay the price, then nobody can tell you that that's wrong. And I'm definitely not going to tell you that's wrong. I mean, I've walked through that, and that's fine. I get no judgment from me. Now, if you don't want to live in front of the computer and have to take the trade, if that's not more your style, and you already have a more analytical mindset where you look at data and prefer to make decisions based off of data and statistics and historical information, but then you're starting to lean towards quantitative strategies. If you're comfortable with programming and computers and managing a portfolio, having multiple strategies that go on at one time, and reading the performance data for each one of those and making decisions off of that, so they're still data-driven decisions, then I think in your heart you're a quantitative trader. So I would explore that deeper. Now, with that, if your tastes are again more to that quantitative trader, we'd love to have you in the Independent Quant community and learning from us. And contributing to everything we've got going on. Head on over to the Independent Quant, sign up for our newsletter, and keep in touch with everything that's developing. We're in 2025, still a fairly new platform where a lot of things going on here in the near future. Look forward to seeing you then, and keep it green.